Hello and welcome to Part 2 of Accounting for Investments to help you prepare for class. It is important that you view this video before class so that we can learn more together in class. This video will discuss how to account for investments using the cost method or the fair market value method. We will also discuss when to use each method. After viewing this video and completing a few practice problems, you will achieve the following. You will know when to use the cost method, be able to account for an investment using the cost method, and know when to use the fair market value method. There are two main things that determine how an investment is accounted for. The first is whether or not the investor has significant influence. An investor that owns at least 20% is considered to have significant influence unless they cannot obtain financial information and can prove they do not have any influence on the operations of the company. The second is whether or not the investment has a reliable fair market value. Reliability is achieved if the investment is traded on a stock or debt exchange, or if there is a reliable cash flow stream. Investments with a reliable fair market value are generally reported on the balance sheet at fair market value. The first method of accounting for investments we will discuss is the cost method. The cost method is used when the purpose of the investment is for appreciation or income and the investor does not have significant influence. A reliable fair market value cannot be determined, which is the case for most investments in private company stock. The investment is reported on the balance sheet at the original purchase cost because it is the only amount considered to be reliable. Any dividends received are reported on the income statement as dividend income. We will use an example to illustrate the accounting and reporting under the cost method. Take a moment to read the example. The key words you should notice are no influence and not traded on an exchange. The entry to record the purchase of the investment is a debit to investment and a credit to cash for the original cost. No entry is made to adjust to fair market value at the end of the year. The investment is not traded on an exchange and fair market value is not reliable. The investment will always be reported on the balance sheet at the historical cost of $125,000. Dividends received are recorded as dividend income and are reported on the income statement. The fair market value method is used when an investment is made for appreciation and income and there is a reliable fair market value. Both the cost method and the fair market value method are used for investments with no significant influence. The cost method is used when there is no reliable fair market value. The fair market value method is used when there is a reliable fair market value. Under the fair market value method, the investment is always reported on the balance sheet at fair market value. The investment account increases when fair market value increases, and the investment account decreases when fair market value decreases. The adjustment to the investment account occurs as an adjusting entry at the end of the period when preparing financial statements. There are two sides to a journal entry, and a change to the investment account requires a change to another account also. The other account will either be an owner's equity account, other comprehensive income, or an income statement account, gain or loss. The other account that changes depends on the classification of the investment. After viewing this video, you should know when to use the cost method and be able to account for an investment using the cost method. You should also know when to use the fair market value method. The next video will cover how to classify and account for investments under the fair market value method. Thank you for being prepared for class. It is very much appreciated.